Hey, hi everyone. This is Finance Meets Real Estate. As you guys know, we're a weekly live webinar every Tuesday at 6:30 p.m. Eastern Time. We gather here. We are also a YouTube channel, so make sure to check us on YouTube, Finance Meets Real Estate over there. We have amazing guests here today from Canada, in fact. So we have August and Ava. They're the founders of CPI Capital. They're real estate private equity. It's a real estate private equity firm out of Canada, which buys US real estate, US multifamily. I'm connected with them on LinkedIn. I know they love US multifamily. They love the asset class. They're going to tell us a lot about it. And, well, I'm really bad at introductions, but basically they do the US multifamily value-add real estate, syndications, private equity. I know you guys did like a tokenized offering as well recently, I believe with Tokenfunder, right? Which is like a company in Canada. So that's really great. So with that, I mean, I'm going to pass it on to you. And so we're going to do a more conversational format today. So if anyone from the audience has any questions, feel free to speak up or put your questions in the chat and I will relate. And I'm sure I'm going to have some questions myself too. Since I'm very interested, and with that, I'm gonna pass it on to Ava and August.
Thank you so much. Yeah, really appreciate it. We're happy to be here and talk all about building a real estate private equity firm from the ground up. So we're really excited to share our thoughts. We see a couple of familiar names, which is great. So hello to the people who know us. Really quickly, about me, I'm CEO of CPI Capital. And yeah, as you were mentioning, we partner with passive investors as limited partners to acquire value add multifamily assets located in the Sunbelt states. We are both hosts of our own YouTube show, Canadian Passive Investing Academy. I'm an author. I love speaking and educating all about the benefits of real estate investing and wealth building topics. So yeah, really happy to meet you all.
Amazing.
Thanks for coming.
No, definitely. Yeah, very happy to meet everyone here. On this platform. Stefan is doing a great job. We're also followers of your platform. We've seen some interesting guests, so we're happy we're here. We can add value.
Yeah.
Also, I think the reason we don't have a slide presentation is we wanted to share our journey with you. We don't come from corporate background or finance background or private equity backgrounds. We come from real estate backgrounds, but for us to have gone through the trenches and built a real estate private equity firm from the ground up, I think will give the best perspective to people joining us, learning from our journey. If you're a passive investor and want to know how these companies are built, how they're operated, this is a great segment for you. Also,
go ahead, August.
If you're also on the active side and you want to learn how to start a company or scale your company, we can also help you with some of our experiences that we had. August Spiniaz, co-founder of CPI Capital. I'm also the co-host of the YouTube show we have. Now we'll get into how does the YouTube show play into the real estate private equity, part of our business as well in a moment. We're really excited to begin the conversation. Is there anything you wanted to add? So should we get right into it?
I think let's get right into it. Maybe Stefan wants to.
Yeah, so if you guys like, it sounds like, your topic is kind of building a real estate private equity firm from the ground up, right? So I wanted to ask you, let's say, like how you guys began, what were your, if you had any prior jobs, like in a different industry, like sometimes some people, or like how you started in real estate, and what attracted you to then transition into the private equity space from, like the more typical like residential real estate or other investments.
Absolutely, yeah. Before we getting into our background, I know you were about to jump in. But I'll let me just describe what is a real estate private equity firm. Now, this term is also, another term that you might hear lots is syndication or apartment syndication or multifamily syndication or real estate syndication. They're all synonymous with each other. Real estate private equity, in my opinion, is a better gives a better description of what our business is. So there are investment firms, real estate investment firms that invest in real estate. They build ground up developments or they buy existing real estate project, but the funds, the equity needed for the project come internally. Whenever you're raising capital for your project, you're dealing with private equity, as the name explains itself. So real estate private equity is a firm that raises capital to then execute his business plan. And that's essentially what it is. In our case, our mandate is US multifamily value add real estate in certain regions within the US. And the equity needed for our project comes from our limited partners, our investors, both in Canada and the US. So that's kind of the basic understanding what the real estate private equity is. Not what is our background and what was our start, what was the impetus for us wanting to begin our journey within this space. Yeah, Ava, if you like, go ahead. And
For sure. Yeah, a little bit about my background is I started real estate at a young age. I was 22. I got in the world of selling and buying real estate for investors. So I had many, many years of working with investors and helping them invest in real estate. And essentially, everybody wants to invest in real estate, right? It's a great place to put your money and build wealth. But a lot of people don't necessarily know where to begin. They don't have the time, the knowledge, or the expertise on where to put their money. So they come to me, and I would definitely assist people in finding the right spot.
As an agent.
As an agent,
yes.
Exactly. But realizing a need that the whole world has, and here in Canada, for people wanting to put their money into real estate. So that's a little bit of a start, and then I'll let August come in and kind of tell about his background, and then we'll tell about how we connected and started building our company and kind of how it all began.
Great companies are, great companies at times are started by a problem being solved. As long as you're solving a problem, you can create a great company and make a lot of profit. And our journey kind of explains the problem that we found within our space. My background is in construction, real estate development. I started as a licensed agent sometime like 16 years ago. I wasn't very good at being a real estate agent like Ava was, but I was good at finding deals. So I started doing small fix and flips, eventually started my own general contracting company, moved on to build custom homes, more on the luxury side for myself and for investors. I always wanted to scale, and I eventually got into ground up development, multifamily. And that's where I saw the pain points that existed in that space, particularly in the location I was in Vancouver, Canada, west coast of Canada, where the timelines that it takes, the time horizon on these types of ground up developments could take a very long time. In the US, you can have a turnaround from breaking ground to completion in a year and a half. Well, in Canada, it's just a year and a half to 2 years just to get your papers, your permits gone through the city hall. So realize a lot of problems that existed. There's no returns. There's no cash flowing ground up development. And also the problem that consistently exists for investors, again, particularly here in Vancouver and Toronto, the larger cities of Canada, is that median home price is $1 million to 1.2 million. Median income is 90,000. So a lot of content that investors receive is from the US, where you make $100K a year, you can buy a home for $350. It makes sense, and you can kind of scale and own multiple single family homes. Well, in Vancouver and Toronto, that's very difficult for most people. So we were always looking for a different option to get people the ability to invest in real estate. And when we joined forces, realizing the problem that existed, we initially wanted to do larger ground up development projects and raise capital to manage those. But when we looked at the US and where we saw other groups similar to us, they were buying already built apartment buildings. They were doing some small renovations, nothing major, and selling it 3 to 5 years, giving great returns back to their investors. But what was shocking to us was the high rental yields that were available in the US, the high rent to value ratios in certain areas in the US. Some people from California and New York might say, no, we also have low rental yields. So we fell in love with the concept. Why bother going through ground up development? Why bother going through environmental issues, dealing with the city, dealing with contractors, dealing with material costs, and you start a project at certain performance. By the time you're midway through, there's cost overruns. You can buy an already cash flowing asset. So we fell in love with the concept. Great, we got our asset class, we got our property type. Now it's time to raise capital. So
and one thing before we talk about raising capital is the beauty of buying an already stabilized asset is dealing with real estate investors. They want two main components, right? They want cash flow and they want appreciation. Very, very difficult to find here where we live because of the very low rental yields and everything else. And on a multifamily apartment community that's already stabilized here in Vancouver, you're going to be in negative cash flow. So two main components real estate investors are looking for. We were able to see that across borders, we could achieve that for them. So that's where the excitement began. And we're like, holy, we could help a lot of people here, not only achieve cash flow and appreciation, but also as a busy professional, the people I used to work with for many, many years, they could still invest in real estate, hands off, completely passive, let us kind of take care of all of the heavy lifting and still build wealth through real estate. So it's a very exciting concept that people need to familiarize themselves with. And we also call it fractional real estate investing. So what an incredible way, again, for people to be involved in real estate, but have somebody else manage all the rest of it and get those monthly distributions.
So actually, Ava, just if I may interject at this part. So you mentioned actually, low rental yields in Canada, right? In comparison to the US. So that's kind of, factual, in the data, right? And so forth. So we have, so how would you say, like, I don't know too many like Canadian multifamily operators, like how would you say they execute their, because presumably value add exists there to an extent, even though rental yields are very low. So let's say, but how do they manage to kind of execute their strategies in a, let's say in the typical, let's say 5-year syndication period or things like that? Or would you say that the whole business plan execution is significantly constrained, due to lack of cash on cash returns or negative cash on cash returns and so forth?
It is significantly different. The business model is totally different. These project-specific syndicated deals are not as common in Canada as they are in the US.
Yeah.
Now, is there a market for multifamily investing? Yes, there is. Larger funds and larger institutions do invest in multifamily, but it's a long-term game. They're buying it for 10 years. They're buying it for appreciation.
Speculation and appreciation.
Speculation appreciation.
Yeah.
Now, another difficulties that we have here in Canada is that the tenancy, the laws are very tenant friendly. So the value add model practically doesn't work. We had guests on our show where—
Can I share?
Of course, please.
This is crazy. And this is one thing that I love talking about because it really puts it into perspective about the differences between Canada and the US. In the regions we purchase real estate in the US is very landlord friendly, very business friendly. There's no rent control. So it's very easy for us to purchase in a growing market and the rents can increase by 15-20% on an annual basis, you guys. Here in Canada, there's very strict laws around being a landlord. You can actually only increase rents by 1.5% in most cases, and that's mostly across Canada. So imagine trying to do a value-add business model where your whole objective is to go in there, do renovations, turn over the tenants, and increase the rents to increase the NOI. We had some people on our show, and August was gonna— I stole what he was gonna say, but
yes.
It was crazy because to get the tenant out of the unit that they wanted to renovate, they actually had to pay the tenant $20,000.
Hold on, let me add to that. This is
Sure.
not getting a tenant out of the unit. This is waiting for the agreement term to finish. And then not the owner not wanting to, the landlord not wanting to renew the lease. Where you can't do that here in Canada, and it's shocking. Mm-hmm. And as the tenancy term comes to an end, they say, hey, we're not going to renew. They can't do that, and they had to pay this tenant $20,000, and this is very common, just to move out, just to be able to get into the unit, just to be able to renovate.
Understood. Right.
And so the business model is very difficult.
Let's say so let's say in the US, rent control is like kind of like New York, New Jersey, California, kind of, I think like more recently thing. And just like a few states, like I believe there's about maybe 4 states. I don't even remember the other one. And so it's like not like so widely spread. So to your point, let's say if you guys invest in Florida or Texas, and it's, it's obviously like super like comparatively landlord friendly there and so forth, there isn't rent control. But you're saying in Canada, it's actually a pretty nationwide thing, sounds like. So like value add is not a scenario, like cash on cash returns are not there. So it's really kind of like big funds buying for appreciation. And and stuff like that. So
and in the places that you can get cash flow, because you can find you can achieve cash flow, but in those places you're not getting that appreciation. So it's really about balancing, getting the best of both worlds, and that's where it's really difficult that way. And then that's where
I mean, if there was opportunities available here, we would have stayed here. Why go through all the hurdles that exist with cross-border taxations, dealing with IRS, dealing with SEC on the regulatory side of it? I mean, there's so many hoops that we have to jump through. On top of that, our investors also have to file. Every single one of our LPs has to file U.S. taxes annually. So it would have been a lot easier doing a deal here locally.
No, but completely understand. Yeah, completely understand. No, the US is very attractive. I think it's kind of like clearly like a worldwide leader for multifamily or something. And I was speaking to a friend of mine in Hong Kong, so he was like considering, who is a venture capital investor, by the way. So he was like interested in, like investing in real estate, and he was looking into multifamily, and like the US came out as a pretty clear choice, from all the regulatory and in returns perspective, and clearly like kind of like the highest returns and so forth. And I guess like to your point, like your discussion of executing a value add that largely relies on raising rents, sort of, and like having forced appreciation, right? It's like not a doable thing, right? It just like totally doesn't even exist as a business strategy.
Sure. So just to add the one last point here for you is all about the rent to value ratios, the rental yields. And US, as far as I've researched, and I've researched all over the world, Asia, Africa, Middle East, I've researched Europe, South America. No matter where you look, the US, in my opinion, I'm not sure if somebody can correct me, has the highest rental yields. In some regions within the US, for single family investments, they got a 1% rule, that 1 month's rent equals to 1% of the asset value. I mean, these are shocking numbers, right? And that's why it's so great that brings international investors like us. And then when we were initially doing research about us, we noticed that on the institutional side of it, the Canadian pension fund, one of the largest pension funds in Canada, is partnering with Greystar to build and buy multifamily. So there is already billions of dollars of Canadian, dollars coming to the U.S. Real estate sector, particularly multifamily already.
Yes.
Right. Very interesting. I mean, on the cap rates, like your point, I think US is super high, and actually I can mention I'm Eastern European myself originally, and so in Eastern Europe, it's actually generally lower cap rates there now than the US. So it's quite interesting, because cap rates are supposed to be a measure of risk, but it's kind of strange. And it's even like in areas, one can think of like in areas that are not particularly like demographically growing, let's say if you have like population decline, you get high cap rates. That's kind of the dynamic in the US, like that you get that in the Northeast and Midwest, you have population decline, super high cap rates, So, and that doesn't seem to be sufficient over there too. So it's quite interesting. It's quite interesting. And what do you guys think on like cap rate compression and, versus interest rates and that?
I mean, we're in a city that I've been in the real estate business in Vancouver for a long time, and I've seen the cap rates compressing here to now on the multifamily to 2%. I mean, it'd be unthinkable in the U.S. So I'm concerned that might be happening. You can see it happening in Arizona, where the cap rates are around 4%. It really depends. It really depends on the yield that investors are looking at, developers are looking at. It depends on how much product is available. So there's a lot of different factors. I also believe that the U.S. has a different investing culture. So that's something that can't easily be changed. If a deal doesn't economically make sense, there's other states, there's other regions you can invest into. Whereas, in places like, Canada and other countries, there's only one real market that exists. In the US, you have so many different markets. The state of Texas alone has a larger economy than the country of Canada. The state of Texas has a larger economy than the country of Russia, the largest landmass country in the world with so much natural resources, and that one state has larger economy.
Absolutely.
So there's just so much business, commerce, so much capital in the US, and the culture is different. So if it's something that doesn't economically make sense, people just move to a different region.
And in terms of, so let's say if cap rates were to compress, but interest rates are still relatively low, but people expecting it's hard to predict interest rates, but kind of people expecting them to rise, let's say, and already seeing some increase already. Would you guys be concerned of like, kind of like some of the commercial multifamily investors' concerns of, like valuations dropping based on interest rates, or would you think, okay, it takes like quite an interest spike for that to happen?
Yeah, like as cap rates compress and interest rate, as interest rates rise and the cap rates rise as well, it will affect the rental yields a little bit. But keep in mind, like, especially for us here on this side of the border, when we're talking about the returns that we can achieve on the US side, it's not detrimental and not too scary of a thing. Investors are aware that the returns might come down a little bit, but the returns are so great as it is that it's not, this scary thing where it's going to be a massive drop.
Yeah, and on the U.S. side, I mean, yeah, there's obviously, interest rates depends. There's a couple of different perspectives on this. That interest rates, the cap rates follow the interest rates, and then there's also some literature that says otherwise. We know that the Fed is going to increase interest rates. I think Ava has been recorded on a podcast having a bet on 50 basis points that it's going to be increased. That's not going to. It's still going to be one of the lowest, historic interest rates. So it's not going to affect the market so much. But long term, I believe in certain regions, there's going to be issues. There's going to be issues with yield. So it's interesting to see, and we're also pretty cognizant of it. So we're watching the markets very closely. Last thing you want is to buy at the peak of the market with investors' capital, because in this business, you're just as good as the last deal you've done and the last returns you provided to your investors. So we're very selective on the markets and the properties we're looking at.
And another thing too, Stefan, what we've been doing is being very conservative in our underwriting. So actually putting our exit cap at a higher exit cap, as opposed to most people, they do their underwriting on the same entry cap.
And the same one, right? Yeah, that's quite conservative.
Yeah, quite a bit higher at 4, and then we did our underwriting at a 4.75. So really being conservative, so the investors know that when we put the numbers together, this is kind of how we were conservative doing so.
No, that's great. And you guys are right. People have been seeing like amazing returns now. And very recently, that's the case, with like all the maybe inflation effects and like rent inflation and so forth. But even before, it's been like a great time, great period for US real estate investors. And so we have a question from Cedric on the chat. So do you raise per opportunity, or do you have a fund and continuously raise?
That's a really good question. Yeah, we're actually
Jack, put yourself on mute, brother.
Jack, I can hear you.
Okay.
We're project specific. So we're not a fund where we have a bunch of deals in one fund where we continuously raise capital. We're project specific. So each time we find a new investment opportunity, we create our entity for that. And then we have a nice investment webinar. And then the investors have about 45 to 60 days to participate in that particular deal. Then we close that deal, and then they wait for the next project to come along.
Makes sense. So it's a private securities offering, right? The syndication route, which I would say like most people do. Like the fund is like some people prefer that, but slightly different structure. And
I call us a syndicate. I say we're a syndicate. We're not a fund.
Yes, but at times it could be done concurrently. So there are groups out there that do syndicated investments, but they also have a fund alongside their investment. So at times, if they don't have a deal, the investors can invest into a fund. There's also other groups that have a fund for different type of asset classes. So they do syndicated investments for their multifamily, but then they got a storage fund alongside their multifamily asset class.
Yes.
Right. And so I guess that we answered the next question, like what fund structure, private, performance based. It's I guess a private SEC offering, right? So it's the legal structure kind of.
Yes.
So next question, like does Canada, US have any bilateral tax treaties which help with the double taxation problem?
Very good question. Absolutely, the U.S. and Canada have a tax treaty in place. So we utilize that to relieve our Canadians dollar for dollar on double taxation. So that's where the numbers really make sense for Canadians, is they don't have to pay double tax.
Unfortunately, LLCs are a kryptonite of cross-border taxation. So if the investment is been structured in an LLC, that makes it not tax efficient and causes double taxation for investors. Unfortunately, LLCs, unfortunately for Canadian investors, LLCs are usually the recommended structure to do, private equity real estate investments. But for Canadian investors looking to invest passively, that's not the right structure.
So keeping in mind for great point, August, and for Canadian investors listening, the terminology is very different when it comes to US and Canada. So it's always good to make sure you reach out to experts before you go making any decisions, because you can get yourself in a lot of trouble if you're listening to a US syndicator who's telling you do this, do that, and they're not aware of how the taxation works.
Yes.
They're not aware of how the conversions work from the tax forms.
They might not be
stuff.
doing it maliciously, but a US syndicator might
know.
say, hey, go to their lawyers, go to their accountant, and says, how can I service a Canadian investors? And they're like, as long as they have an entity in the US and as long as they meet your requirements for the exemption you're using, they can invest with you. And those advisors might not know that the LLC that the project has been structured into is not tax efficient for Canadian investors. And one more item on this is also the tax treaty that exists between Canada and the US. It also exists with many other countries around the world. So this concept of double taxation, could be relief from other people investing from Great Britain, Australia, other countries. So there is tax treaties that exist, not only with Canada. I just want to add that in.
Mm-hmm. But let's say, so to recap, so you're saying, so foreign investor, let's say coming from Canada, investing in the US, so they need to open an LLC in the US, like limited liability company in the US, is like kind of the very initial step. But from there, they need to make sure with their, like they find like a CPA and etc. to really tax optimize the double taxation side of it. Is that right or no?
Uh-huh. So it goes back also to the requirements of the syndicator operator. So as long if the asset that's being purchased is structured in an LLC, that is not tax efficient. Most times, for example, a limited partnership structure is suggested. So now a foreign investor can be in the U.S. or come to the U.S. or remotely incorporate a C corp or LLC and invest into that entity that owns the asset. So that's something. Obviously, I'm not an accountant or a tax lawyer.
We're not accountants. We're not a tax lawyer. We cannot give you guys any advice here.
There are. So what we can say, black and white, is that if an LLC owns the asset, which most syndications are done through LLCs, that's not tax efficient for most foreign investors, particularly Canadian investors.
Yeah. So just be.
Just be cognizant of that, get advice, and so on. Yep.
Yeah, and to get advice from, like, would it be like it wouldn't be like a regular, like US or Canadian CPA. It's like one who is like cognizant and knowledgeable of international taxation.
Cross-border tax accountant. If you just Google that, information comes up.
Yeah, makes sense. Mm-hmm. Got it. So, okay, so.
We did want to touch a bit more about our,
go ahead.
About our background and what have you. We want to talk about.
Absolutely, yes.
So now we show up to the party. There's all this money to be made in the U.S. It's happening on the institutional side. We love multifamily. Great. Okay. So now what? So okay, we partner up. We create CPA Capital. Okay, great. August, call all your friends, all the people you've made all the millions of dollars for building projects. Call them up to come and invest with us. And Ava, call all your friends and family. Call your investors, and let's raise a bunch of money. And we're gonna buy. The first property we looked at was a $66 million multifamily project being sold by Blackstone in Arizona. So we're like, all right, $20 million, no problem. We know
lots of people. This is going to be a piece of cake.
We have 1,000 people that have been added to our investor database.
So just to hold up, your first, so you guys came from, let's say, Ava was an agent, like agent background, right? And you're a developer and like successful in your careers this way. And your first syndication, and that's when? 2019 or earlier?
2019.
2019. We were trying to do our first syndication.
Don't give up.
Don't
give it up yet. But yeah, so we show up.
Syndication 66 million.
66 million at first deal. It's a $20 million equity raise. We have our team. We put everything in place. We have our key principals who are guaranteeing the loan. We have our asset manager who's been to the property, toured the property, and
we put an offer in. We make it to best and final.
Yes.
Right?
We make it to the best and final, and another group comes in and buys buys it
Like-
for 75 million.
76 million.
76 million, yeah,
Like
75.
completely way overpriced.
And they just
bought it with one investor, one institutional investor.
They're a private equity firm
Okay.
to buy one, but that experience, the type of response we got from our investor community, a lot of times we saw, other people who had an investor database, and they openly talk about it. For example, your guest Neil Bow Wow
Yeah.
talks about that he has 500 investors,
Yeah.
and he raises tens of millions of dollars
Tens
a
of
year.
millions.
So as new people in the space, we thought, hey, we have 1,000 people on in our database.
Like just doing the numbers, okay, we know that these people are accredited, da 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 da. We're
You
going to
know.
bring a deal and the money's going to come.
Yes.
And that's, let's just say it was a very humbling experience for
definitely.
us.
Definitely.
So that's the beginning of our...
And also what we
It doesn't
realized,
work like that. It actually
doesn't work like that.
It's not about like, oh, if we have a great deal, people are going to invest. That's not the way it works.
No, keep in mind, on the first deal that we did, we didn't actually start raising capital. There were some soft reserves, but the type of response that we were expecting, it didn't turn out to be the way we thought. I'm certain we wouldn't have been able to raise the $20 million in
We didn't start
equity.
raising capital because we didn't get the project under contract, right? So we didn't actually present it to our investor base because we got blown out of the water by the other people. But
yes.
again, it was a very humbling experience. And this is just, we wanted to share this story because we're talking about building a real estate private equity firm from the ground up, literally. And we wanted to go through our trials and tribulations that we had to
Absolutely. And just to add to that a bit more here, Stefan, jump in anytime you like. But
Yeah.
but what, so now we come to this moment. We first deal, we try to buy a $66 million deal. Somebody comes and buys it for $75 million. We don't get the response that we wanted from our investors. So we realize that we need to spend more time. Just because people have signed up to your content, just because people are part of your community and they're opening your emails, it doesn't mean they're going to invest. Particularly with a group who has no track record when it comes to US investments, has not had any deal going through its full cycles, has not returned capital back to investors. So we realized early on that we need to create a lot of know, like, and trust before people are coming and writing checks and transferring funds. And that's,
laying out the actual concept of real estate syndication. A lot of people they didn't quite understand it, right? They're like, well, how does everything work? This and that. So that's where we started our educational platform and we became thought leaders.
Mm-hmm. And just to interject, so just to clarify, these were all retail investors, right? So you guys were not chasing institutional capital at that point. So,
yes, exactly.
Institutional, it's a pretty big deal size, right? Which is sort of, in theory, could be, export that route as well. But those were retail, exactly. Mm-hmm.
Exactly. And also with the institutional investor, the research that I did, the requirements that institutional investors have, a lot of times I hear smaller groups pursuing that, that channel. I personally don't believe it's, now after 2 years of being in business, we finally have an institution that ended up being close friends of ours, and they're coming in and they're making a small investment just to test the waters after doing so much work around it. So my suggestion, anybody looking to start an investment firm or real estate private equity firm is keep your focus on the retail investors, people that you can connect with within your own demographic, rather than trying to raise capital from institutional investors who are very sophisticated, who have an executive team that their job is to vet sponsors, operators, and deals that comes to them. So that's literally their job, and they're going to be able to see, the experience, the track record. So it's not going to be a very easy sell. So this is the stage we're on. The humbling experience we're on. So we're like, hey, listen, we have to connect with our investors. So we put systems and processes in place. Just because someone signs up to your platform, they need to be on a call. They need to get on a call, get to know us. We need to learn a bit about them. They need to be onboarded to our investor portal. So if we put systems and processes.
Yeah, because keep in mind, guys, it's like the minimum investment is $25,000 USD. That's a big chunk of money. So for somebody that, never met you before, for them to just cut you a check. So we started creating this really tight-knit investor community where I would personally get on a Zoom call with every investor that signed up, and we'd get to know each other and start the conversation. And then on top of it, they'd be added to our investor community database where we would send out educational information all the time. So constantly they were learning about how we do things here at CPI. And then again, we were building that know, like, and trust with people. So we really put a lot of dedication into that particularly.
So, yeah, just if you don't have any more questions, Stefan, at this moment, I can keep adding to it and continue the story. But at this juncture, great. So we're moving along, but we realize that we're spending so much time on the investor cultivation, on the investor nurture, and the operational side of our company. A real estate private equity firm is really divided into three main pieces. Look at it as a pie. A piece of the pie is the equity piece, the capital needed for the projects. Another piece of the pie is the deal, is the acquisition, the underwriting, the physical due diligence. So that's the acquisition piece. And the other piece of the pie is the management, the renovations, value add, property management, overseeing the property management. So we realize that we're spending a lot of time, resources on the equity side, and that we're going to be overextending ourselves if we're also being involved in the acquisition side of the project, making that connections with brokers and, flying from states to states and visiting properties. And that's when CPI evolved into partnering with active operators who acted as our boots on the ground. So we're like, okay, what are the regions we want to be in? We want to be in Nevada. We want to be in Arizona. We want to be in Texas. We want to be in Florida. We want to be in North and South Carolina. Who are operators within this region that we feel comfortable working with? We created a requirement of what we look for an operator. So obviously it cannot be a large operator like the Blackstones of the world, BlackRock, that they wouldn't even talk to us. And it can't be a smaller operator who's just done one deal. So our requirement, for example, was an operator who has at least $100 million of assets under management currently, was an operator that has already taken deals through its full cycle, as an operator that obviously has had return capital to their investors. And also they were very transparent and they were very open to put us in touch with past investors, and they can share numbers with us of how they've performed on the past numbers, and also that they had never lost money on any deal. Now, losing money happens. I hope it doesn't happen to us or others, but it's part of the business that happens. There's risk involved in business. Real estate is cyclical, so there's situations, black swan events that could take place. As long as it's not incompetence or unscrupulousness, it does happen in business, and your investors understand, and if they'll come back and make more money with you in the future. So that was one of the requirements we had for these active operators that we were going to be being partnered with. Now, creating that brand, becoming thought leaders in the space, and the content we were creating also helped us with connecting with these operators. So a lot of time the operators are not just looking for a group who's going to show up and bring some money, but they're looking for a group that's going to keep their word, that they're known within the space. And that was our, building ourselves as thought leaders in the space, creating a lot of content, also opened the door for not only operators to be open-minded to partner with us, but also them approaching us. So that's so far. So I can continue the story. Let me know if you have any more questions, and I can keep going to the next stage.
Right. Yeah, so just to understand, so let's say your first deals, they were kind of like your own, you're the sole sponsor on those deals.
No, so the first deal we did, it was a deal we did the co-syndication. So it was a large project. The first deal we did was a $92 million asset. It was a $32 million equity raise.
In Orlando, Florida. 350 units.
Probably the farthest point in North America from Vancouver. If you look at Vancouver on the map, the farthest point on North America is like, it's literally the Florida panhandle. So yeah, I mean, it was again, another humbling experience, because when I took the deal to many of my investors who've made a lot of money with me in the past, they were used to me being a Vancouver developer, a Canadian, ground up developer. And when I said, hey, we're buying an apartment building in Orlando, these are the type of returns, you have received cash flow, it wasn't as easy as conversion that I was hoping for. Again, it was
educating people on
how it works, and it was educational for us as well.
Yeah,
so,
absolutely.
But again, like, just so that, like, for our audience, like, so you guys partnered on it, so that you were like one of two syndicators or a bigger team of syndicators, right? Who actually executed the business plan and the capital raising for $33 million. So that's a lot of
co-general
capital raise. So that At that point, you guys were able to, when you went to your network and so forth, your retail investors investing 25,000 minimum, right? Or 50,000 minimum, you were able to do that. So what helped you achieve it versus the first deal? Even though the first deal didn't actually get to the same stage, because to your point, it was more effective during the bidding stage and so forth, but what kind of development happened that you were able to do that?
Very good question. Yeah, it goes back to we realized that we had to dedicate our time to creating really strong relationships with our investors and providing them with a lot of value so that they can know, like, and trust us. So we spent, from the first time we tried to do a deal, how long was it after? I think it was
probably I would say probably 8 months. 8 months. 8 months to 10 months.
We spent 8 months before we wanted to take on another deal. So imagine the people we met and the content we created and the value we provided to prepare ourselves for when we take on another deal, to have the investors ready to go and be kind of cooked before we presented our next deal.
But also keep in mind, even the first deal we did was again a humbling experience. It was again a realization that we need to put more work onto it. So when we went into it, there was certain numbers that we were looking to hit, and unfortunately we didn't hit those numbers. We're still kept our operating partners happy that we ended up doing another deal in South Carolina with them. Yeah. But again,
things don't happen overnight. So you have to be, if anybody wants to start a company like this, it's a long-term kind of, what's the word I'm looking for? A long-term
horizon.
Right. Yes.
And which platforms? And I'm going to go into other. We have other questions on the chat as well. But which platforms were most useful to you guys? You guys like LinkedIn, right? And then would you say that website, sort of Google search optimization, like SEO and things like that, brought some investors, and then you get them on a Zoom call, and then those Zoom calls kind of build the relationship, or what was kind of the funnel or flow that was most productive for you?
So I asked the same question. I was in Columbia, South Carolina at a capital raising summit, and I asked the same question from our mentor Dan Hanford, and I got in trouble for asking that question, because I'm like, hey, if you had to put all your eggs in one basket, raising all the money you've raised, what would that be? Where should, if we were going to put our energy into one place, where would it be? And he said he used an analogy of a fisherman. He's like, if a fisherman has a fishing rod, they'll catch a fish. But if a fisherman has multiple fishing rods, your odds of catching fishes are much more. Mm-hmm. Obviously, being a smaller firm, it's difficult to overextend yourself financially, resources, and the time that you have. So it's difficult to be everywhere. But that's the approach we took. We have our YouTube show that we create content there. We refurbish some of that content, post it on our social media platforms. We're very active on LinkedIn. We create newsletters and other items on LinkedIn. We're somewhat also familiarizing ourselves with SEOs. We have in-person events. We speak on many other platforms.
So long story short, I was going to say, put a bunch of fishing rods out.
Yeah,
right?
Exactly.
You have to actually be everywhere. And there's ways that you can do that by creating content on one YouTube and sharing that content on every single platform, social media platform, and use the same post for each platform.
And now the route we took for building a real estate private equity firm was to be thought leaders within this space and create content. So if you Google Canadians investing in US multifamily, we'll probably pop up somewhere in a video or on the first page without doing any SEOs organically, because that's the niche market that we're in. But that's not the route people always take. Sometimes people have, they're part of a certain fraternity. You have surgeons or doctors who've left their profession to come into the real estate private equity space, and they leverage their connections, their network to be able to do such thing. You have people that, are pilots. We have a fellow who's coming on our show, Turbine Capital. So he focuses on that demographic. So the way to get, build a real estate private equity firm and raise capital doesn't need to be through being thought leaders and creating a lot of content. It could be achieved through, depending on what your network is. Some people come from Wall Street. Some people come from the finance world. So some people have very wealthy family, right? We know some people who started a private equity firm and their first investor was their parents, their dad, right? So there are different ways. This is a way that has worked for us. We leverage what we have. We enjoy being in front of camera. We enjoy speaking, like you guys see us tonight. We enjoy creating content. We enjoy educating. So that's we leverage what we were good at. So and for other people, you can leverage what you're good at, whatever that may be.
Totally. Yeah, well said.
So your niche of kind of being like the the primary firm for Canadians to invest in US multifamily helped you, like in a way, like kind of being recognizable and so forth, and also like to Ava's point, kind of like putting like multiple, like if you have a video, you put it kind of everywhere, right? You kind of try to you test the different waters, so to say, and right. We have a question on the chat. So what is your, I guess more on the investment side, what is your targeted yield in most of your deals? What is the terminal cap, and are you looking for a spread? And I know you mentioned on exit, kind of projected exit cap that you guys use, but
Yeah, so the majority of our LPs currently are from Canada. So again, like Ava was mentioning, the yields, the product that exists, the investment product that exists in Canada, the yields we're offering, we're blowing out of the water. Anything that's available here in Canada, we're providing preferred returns. We are doing monthly distributions deposited into investors' accounts through EFTs. So our product is already very competitive compared to the market. But really, what we look for when we look at a deal, there needs to be preferred returns. The property needs to be stabilized, so there is no term that we're waiting for it to get stabilized. So then we can send out cash flow. We want to do monthly distributions. We're looking for mid-teens, high-teens IRRs in our project, 3 to 5 year holds. Pretty classic standard multifamily syndication models that we utilize. We don't want to get into deep value add projects, even though the profits could be larger in those deals. And also, focus is very important. I've got in trouble internally with our company because I've had great opportunities come across my desk, and I was about like, oh my God, this is amazing. I'm going to sell everything I have and get into this deal. They're like, no. Our mandate is US multifamily value add within these regions. So yeah, I mean, that is basically our focus currently, to get the best yields possible for our investors and hit those metrics that is basically our goals.
And are you guys, so Jeffrey is asking, are you guys open to non-accredited investors?
Initially, when we started out, the plan was to democratize real estate investing. That was our plan. Yeah. Early on, right away, all the advice we got from our lawyers, accountants, advisors was don't bother. Are we still, do we still hope to be able to work with non-accredited investors? Unfortunately, the space is, the space has been built to, unfortunately, to make the rich richer. I had a young fellow who contacted me and he said, hey, how can I become an accredited investor if I can't invest like one? How can I, live like the 1% if I can't invest like the 1%? Unfortunately, the system is as such that makes it more difficult for non-accredited investors to participate in these opportunities. So, is in our heart, do we want to work with accredited and non-accredited investors? Absolutely. But just the way that the system has been created both in Canada and the US.
And the timeline and the expense, it's just very difficult we have a very short timeline that we can raise capital. We'd have to create something called an offering memorandum. It's an exemption that we can use here in Canada to raise from non-accredited investors. Well, that offering memorandum is like a 200-page document, very costly. And it takes the lawyers probably about 3 weeks just to put it together.
Best case scenario, 3 weeks.
Best case scenario. So imagine the difficulties for us if we wanted to do that. Then we're left with maybe 2 weeks to be able to do a capital raise.
And then also an OM, they need audited financials, which at times might be difficult to get your hands on it. Send it to a third-party accounting firm.
It makes it very difficult again. So yes, originally starting off, we really wanted to democratize real estate investing, allow non-accrediteds to participate, until we really started getting in deep into the business and seeing all of the restrictions that are on us in order to raise. And
just compare that to the equities market, compare that to the stock market. You could go sell your house today and go buy a single stock, not even an index fund, and there's no risk to it. But if you want to invest in real estate private equity, which is backed by an actual tangible asset, the process is made so difficult. So there are certain initiatives, there are certain plans. I think the province of Alberta raised the crowdfunding exemption to $5,000 from $1,500. So there are steps in place. Investors are out there, wanting to be able to invest.
I will be creating a fund sometime in the future where I will have an OM and non-accredited investors can participate. 100%. That is my goal. I want to help everybody build.
Great. That's a great answer. And I mean, I assume like there's also the question of like kind of like pre-existing relationship, right? Establishing pre-existing relationship and so forth for non-accredited investors.
In the US,
in the US.
Canada, we don't need, if you're utilizing the offering memorandum exemption, we don't need those pre-existing. In the US, the 506B, that's the case. But with us, as long as you have an OM, you can raise capital, any amount from anyone. It's just the OM has certain requirements, which makes it very difficult for these syndicated deals in a competitive market. You're putting down a non-refundable deposit, you're about to close, raise capital in 60 days. Now, if you're waiting for a lawyer to finalize your documents for 5 weeks and you can't raise $1 until that date, you're put into
I see. That's interesting, actually. So, because actually, what is the equivalent of the SEC in Canada? I'm sorry, for my ignorance on that, kind of the equivalent agency.
It's provincial. So we have, instead of states, we have provinces. Each province has its own securities commission. So we're
its own securities commission. Got it. Okay, got it. And
security commission has its own regulation. So if you're raising capital from province of Ontario, you have to follow those regulations. If you're raising from BC, you have to follow those regulations. They're somewhat similar, but they're also different in some cases.
So your securities, I mean, you need to kind of hire attorneys that are knowledgeable of each of the provinces, specific rules and so forth. That's quite involved. And then to what extent that's regulated by the SEC, just to the extent you get American investors, right? Or it does not apply in any way, with regards to the property being in the US.
Sure.
If 100% of your investors are Canadian, you would be fully under the provincial, the separate provinces securities was, right? Presumably.
Yeah, exactly. Well, we're raising from Canadian and U.S. investors. And as you recall, we said that we partner with U.S. operators. So they're bringing on a significant portion of the equity as well. So we essentially deal with the Canadian security regulators and also the SEC. So now, as far as our requirements that have been put on us by our operating partners and the SEC regulations. So if our operating partners and jointly we're utilizing the 506C offering, which is accredited investors, now what we do is we create a fund of fund structure. So it's a feeder fund that we create in Canada. We create a fund, our Canadian investors invest into the Canadian fund, and then the Canadian fund invests into the US fund alongside other US investors, just as this individual LP. Now, what the SEC wants says that all your US investors need to be accredited, and there needs to be third-party accreditation or proof that they're accredited. But the operator says, but hold on a second, also have this one Canadian entity coming and invest with me. How can I make sure this, what do you need from me to prove to you that this entity is also accredited? And the SEC says there's two ways you can prove that this entity is accredited. One is if this entity is investing more than $5 million.
Automatically makes it accredited.
Or if every single investor within this entity are accredited. So that's kind of the regulatory hurdles that we have to jump through to be able to invest into, as long as it's a 506C offering.
Mm-hmm. And the question on the chat actually is, related to that. What percent of your investors are Canadian? What is the percent of Canadian versus American investors you guys have, let's say, at the moment? I'm sure it changes, but
just went through the numbers. Yeah.
What was it again? The numbers.
So then what we noticed, so there's some growth metrics we have. So we noticed that we on our first deal that we did, we had 0 US investors. And then the next one was 100%. But now it's gone to, I have all these numbers. Should I pull it up somewhere?
We had a 20%, or we had US investors, and then we had a 60% increase as the deals were going for US investors.
So our US investor growth has been much
each deal there's more and
larger
more
than
more,
the Canadian one.
Yeah.
But if you compare the two investors currently, I would say probably 80% of our investors are Canadian. Is that fair to say?
That's fair to say.
80%. 80% of our investors are Canadian. Now, the plan for Ava and I are also to eventually make the move to the US. We probably will still have, depending on how our company grows. Currently, we've brought a lot of awareness to our company and our brand. So, we have people joining our platform daily and, so on and so forth. But the plan is to be in the US. I mean, you got such a big market in the US. You have over 10 million, and some people are saying even 20 million accredited investors in the US.
Yes.
But
to always keep our Canadian roots. I'm third generation Canadian myself, and we'll always keep our Canadian roots and always be assisting Canadians to invest across borders as well. Even though our plan is to one day go to the great country of the United States of America.
One day, you make it sound so far away. It's going to be pretty soon here.
Next year.
So Jeffrey is asking, can you generally solicit a deal in Canada to non-accredited investors, assuming you can work around the OM exemption?
Yes, you can 100% solicit. Now, if there is some other regulations where it makes it a bit more difficult than the US, that if you are soliciting repetitively, if you're continuously creating these SPVs, and if you're continuously rinse and repeating the same business model, you might be triggering the what is it called? The licensed requirements. So there is some issues if you continuously repeating it. In our case, the way we've alleviated that is all our securities are sold through an EMD. So the actual sale of security takes place to our EMD Tokenfunder, where the funds are actually transferred to Tokenfunder, then they're transferred to us and transferred to our US partnership. But yeah, so as long as you're utilizing the OM exemption, you can solicit and you can advertise.
Okay, and since you mentioned, that's a great answer. And since you mentioned Tokenfunder, so just to understand, like I've spoken to I'm into most syndicators to some syndicators, meaning on this topic with regards to blockchain, and there is some level of aversion, that may make some operational aspects more tedious and so forth. And I know there's some sort of they're used to the way they're doing business currently at the moment and so forth. But you guys worked with Tokenfunder. Was that on your first deal already, or was that at a later stage?
Our partnership with Tokenfunder is on the clearing service and the compliance and regulatory side of it. So they assist us. We've just talked about for being fully compliant. But
for setting up the SPV, setting up.
No, the SPV is set up by our securities and corporate lawyers. The sale of the securities is done through Tokenfunder. And the clearing service is also to accredit our investors. In Canada, we don't really have third-party companies like you guys do in the US where they accredit investors. Tokenfunder also does our accreditation for us. So those are the two main services they offered to us. They also have an investor portal. So we jointly created an investor portal, which we service our investors through. So those are the main services they provide. But now Tokenfunder itself, aside from being an EMD, being an exempt market dealer, it is the first licensed platform in Canada, or might be even in the US, that is allowing a secondary market for sale and trade of securities. And just for me to I know and it utilized the blockchain, the Ethereum blockchain to create these trades and the sale of securities. No, that's tokenized
the
so this is
partnership.
This is
that's
sounds
kind
like
of additional. So
just for me to break this down, how it works. So in a standard syndication, investors come in, the equity is raised from investors. Investors receive limited partnership units or shares, or however you want to call it. In our case, is limited partnership units, pari passu to the investment amount they've made. Just basically a piece of paper. They've made their investment relative to how much they put in. They receive this document. What Tokenfunder has done is tokenized that limited partnership shares and has created a secondary platform, like a marketplace, like a mini stock market, where people investing with CPI or investing with other companies or other asset classes can take these illiquid notes, these illiquid investments, units, and then trade them on the secondary market. That's essentially the technology. Now,
because historically, in a limited partnership, you're committed for the term of the project. So this creates kind of a sense of excitement for investors, because now this is no longer illiquid. it's liquid. And a lot of investors, that's one of the first questions they ask me, well, how liquid is this investment? So this is kind of a really exciting concept where we actually have a digital wallet that investors set up in the investor portal. And we're going to start kind of rolling it out that way.
But keep in mind, this is early stages.
Early
We have actually lost some investors when we onboard them to the portal and they talk about, oh my God, Bitcoin.
But you're not required to set up your digital wallet. It's just an option should you wish to.
Yes, but sometimes it complicates things. This is very complex. It's hard enough to explain to people.
Technology is...
It's hard enough to explain to people what a limited partnership is. It's hard enough to explain what syndication and this real estate private equity is. As soon as you talk about blockchain and liquidity of shares and everything else,
further. That makes sense. Yeah, I think that makes sense. But you guys started working with them essentially due to sort of their securitization like capabilities, right? Not related to blockchain at all. It's just like simply being able to set up your securities structure.
Exactly.
And now, in addition, they have that secondary market kind of capability, and you can say to your investors, okay, you don't need to stay in the deal for 5 years. You are able to, assuming that secondary market kind of develops over time, also because it's in very infant stages, right? But you're able to sort of then, exit on that secondary market. And you're saying that may have had like, not sometimes positive, sometimes more confusing effect on the investors. So it's not like the current infancy stage of this whole technology. It's actually not even a clear capital raising benefit, if at all. It's more of it's more like, okay, that's an additional like supplementary capability that is there. Is that a fair?
100%. 100%. But
and I will say, I believe in the next 3 to 5 years. We always say this is the future of real estate because I believe that it's really going to roll out in the next 3 to 5 years. But one really important thing to note about investing in limited partnerships, such as our business model that we do, this is just security for an investor should they have something in their life where they need to exit the project. You do make a lot of your profit on the back end when we sell, right? So in most cases, you may or may not want to exit the project, but it's again, having that kind of security to be able to do so.
Tokenization hasn't been created to create just because somebody had a bad couple of years and they need to exit an asset. It's actually to create liquidity in illiquid investments, and not only in the real estate space, but in a lot of other spaces. And you can see that happening with NFTs and what have you. So this is kind of the future of technology, same way that how internet came about and it changed everything, and you can see lots of businesses close as a result of being able to order online. You can see that blockchain and cryptocurrencies are doing that with the financial space. Tokenization is having an effect on this in the security space and other spaces as well. So that's that.
And if we can come back just for a second, I'm interested myself, like we can come back a little bit to the capital raising side, because I feel you guys are kind of superstars of this. Like I feel you're very strong still. Like if you look at other like syndicators, like the majority of them, even experienced syndicators, they do smaller deals. Like you started at a very high bar, you were able to execute it, and that. So would you say it's this the fact that, since you mentioned even now you're like 80% Canadian investor, would you say it's the situation of not actually being like the typical syndicator in the US, like typical US syndicator that has to compete against 1,000 others, but more like, okay, you're the only one that does it for Canadians, for like one of the few. And is it this unique position that helps you, or is it more, okay, just to Ava's point, putting your fishing rod kind of everywhere and like actually, doing more work and, kind of like pushing it more than others? So
yeah, that's really, really great question. And you know what, it was crazy when we started to have a bunch of US investors sign up. What I realized, investors want an experience. Okay, they want to like come in and literally have an incredible experience when investing with companies. So when there's all these syndicators in the US and investors are coming to us, it's because they realize that they're going through this really amazing experience and they're kind of enjoying it along the way. Yeah, that's one thing I wanted to. For sure. And for me, I would say, is us somewhat having a monopoly in Canada currently been the reason for our growth? Somewhat. But I would say, if I had to predict, I would say if we would have followed the exact same model we're following now and we would have been in the US, we would have been 10x. 10x. Yeah, we've talked to a lot of...
The investment culture is different.
It's
Canadians
way
are
different.
hyper cautious.
Hyper.
They're conservative. They know, like, and trust needs to be there. They want to make a $25,000 investment. We got to invite them to our house and have dinner with them.
10 times.
10 times. The U.S. investors,
they call me and they're like, hey, but what's the minimum investment? I'm like, do you want to jump on a Zoom call and get to know each other?
Yeah.
No, what's the minimum investment? I'll double it right today.
No, what's the minimum investment? 25,000. Okay, put me down for 50K. So no, it's a totally different world.
Yeah.
Your minimums are lower even in a way, right? Perhaps to reflect the Canadian sentiment. Or
exactly. So no, has it been somewhat helpful for us to be the new kids in town and bringing these great opportunities to Canadians? Sure, yes, it has. But again, I believe the U.S. don't. And sometimes I talk to lawyers and syndicators who are thinking about bringing on Canadian investors. I'm like, believe me, I've been researching on a lot of larger real estate private equity firms who started out in Canada, and now majority of their retail investors are in the U.S. and they're shifting to being more U.S. focused. Yes, there is money in Canada. Yes, sure. But if you're in the U.S., why bother? Why bother with 2 or 3, or whatever, the handful of Canadian investors? Focus on the U.S. And as long as you follow the processes step, as long as you have a niche, as long as you have a message, as long as you are able to create a community, that investors come in and they can feel like they're part of something.
Yeah.
They're making a difference. Like Ava likes to call it the win-win-win. The tenants are winning in the buildings that we buy because we build, we renovate and build better communities for them to live in. The community wins because we're creating jobs and people can work there. And our investors are winning because they're getting great returns on investment. So this is a great business to be in. Nobody's really, losing within this business. So that's kind of the community and the impression that we're creating for people joining us.
Absolutely, and those are great pieces of advice there. And so what do you guys think about inflation? Kind of a popular topic right now. With regards to hard assets or with regards to real estate, I guess in particular.
I mean, what's the greatest hedge against inflation? It's real estate, right?
Real estate, yeah.
So now with inflation, I mean, the concern for us investors is that to combat inflation, the central banks have to raise interest rates, but the system is a bit fragile currently, so they might not be able to hike those interest rates drastically because that could shake the whole market. So we're cognizant of it. Inflation is also affecting rents, incomes. Rents are not the ability to the incomes are not growing at the ratio that rents are growing. So we're definitely cognizant of what's happening with inflation, And
so you guys, so how many deals have you guys done so far?
We've so far done.
That's not a secret. Yeah.
We've done 3 deals so far.
3 deals, right? I mean, because they're pretty huge, right? So it's a lot of harvesting kind of up front and then getting it getting it across the finish line after.
Yeah, one in Orlando, Florida, one in Charleston, South Carolina, and one in Houston, Texas.
That was actually exactly my question. Okay, so Florida, South Carolina, Texas.
And stay tuned because we're planning on doing, hopefully, our target is to bring greater investments to our investor community every couple months. So we're planning on doing 4 to 6 more deals this year.
Yes.
And
what? Yeah, for sure.
Ahead, you were gonna say
one more topic on this idea of building a real estate private equity firm is interesting for me to say, because a lot of times, real estate investors, they create their own investment firm. So they scale. They start with a duplex and they scale their way up and buy a 20 unit or a 50 unit, eventually being able to scale up to buy an institutional asset. With us, when we got into the business, we walked in creating a real estate private equity firm. So the idea to start small and go big, that's not an idea that we subscribe to. The idea was to what is the best possible investment for our investors, and that's institutional multifamily with a value add component in a growing region. So and that those assets are starting at $30-40 million. So that was kind of our business model walking in. Obviously, it's very difficult to get into it, but this syndication model.
One thing you always say, and you say, don't let numbers scare you. Don't limit yourself. to, and, have limiting beliefs. And once you have that mindset, as August always says, you can really accomplish anything.
Yeah, the syndicate, the risk of private equity space allows for, you look at it this way: as sponsors brings, in some cases, hundreds of investors together. They're already doing a lot of work doing that. Now, they could also bring in other co-syndicators. It's a lot easier bringing in a co-syndicator who brings in 50 investors, another guy brings so it is a model that can be utilized for the general partnership side as well. So you're syndicating with investors, but then you can also syndicate the general partnership as well. So we love it. It's a great
Team
model.
sport, yeah.
So how do you go about picking your property managers? I know we are already over time, and you guys have been very generous, like answering all our questions, my questions, but a question on the chat on the property management side. Like, do you use like the kind of incumbent property management that was went with the asset, or do you try to kind of add value on that side as well?
Yes, that goes again to that piece of the pie. That's the management value add piece of the pie. So currently we're subbing that out to our operating partners. So in most cases, we when we're looking at a deal, the deal gets presented to us. That's one of the first questions we ask: who is the property management firm? Who's going to be looking after the renovations? And who is the asset manager that's going to be overseeing the property manager? So in most cases, we have trust in our operating partners, and we go with what they recommend as far as the property management. A lot of times the operating partners have a certain property manager that they've worked with who manages many other properties in that region. Yeah. In our Houston deal, that we just closed, our operating partners has many deals within that region, and they use the same property management
vertically integrated.
And so it's for us to come in and create tension. It doesn't really make sense because they're very much invested in the project as well. So so currently we go with the property manager that our operating partners are working with.
That makes sense. And you guys join as co-GP and on the project, presumably, and understood. And do you guys have any questions, like just for our audience, like if you want to speak up before we wrap up for today?
August,
you guys are not feeling shy.
No, the questions for them, not for us. Who are we going to ask questions from? We're going to ask Stefan questions.
No, just for our audience. So, a question from Steven is asking, actually, your operating partners do what besides, let's say, big property manager? Well, I assume it varies, right? Sort of the active sponsor responsibility split, right? It's kind of can vary, but I guess his question is, what kind of responsibilities they would have in that sense, besides, let's say they pick property manager or have a property manager in place and perhaps take care of some of the renovation. It's kind of I assume it's a pretty fluid question of like active sponsor responsibilities.
Mm-hmm.
Yeah. So now again, this is another unusual thing between Canada and the US. Property management firms in the US, they actually get involved in the renovations. Across Canada, we have never heard about a property management firm that gets involved in any type of renovation. So in our case, with the operating partners that we partner with so far, they have a part of property management they have a relationship with a property management that's in place already. We have this is more on the regulatory reasons and for us because we have to take care of our investors. So we have bi-monthly meetings with the asset manager who updates us on what's happening with the vacancy, what's happening with the leases, what's happening with any upgrades, how things are at. So we're there hands-on, having
our
those
responsibilities,
having our bi-monthly meetings with the asset manager who looks after the property manager, oversees the property manager.
Yeah.
Mm-hmm. And so another question on the chat. So can you explain your co-GP structure is more 50-50 and you raise LP equity? Well, if it's two sponsors, then it's kind of 50-50 raising LP equity, right? Presumably, but
it goes back to that pie.
Co-GP structure.
Mm-hmm. It goes back to that pie that I explained. So the equity is just one piece of the pie. The asset acquisition, the management is the other piece of the pie. So the GP profits, the promote and the fees, the real estate private equity, how does the sponsor make money? They make money from the management fees and performance fees, or fees and the promote. So now that
Yeah, so just really quickly, Stephen said is an LP GP split. We do a 70-30 split in favor of the LPs. Okay, so just to highlight that,
Sure.
I just wanted
Okay.
to so from that 30%. There we go. I just wanted to that was somebody. Put that out.
Thanks for clarifying.
Okay, cool, great, yeah, awesome.
So from the GP split, it goes back to that pie. That's what we were talking about.
Yeah, so when in a co-syndication model, when there's multiple GPs or there's two GPs involved, it doesn't diminish investors' returns. The 30% of the promote gets divided amongst the GPs relative to what is their input, what is their duties, what they're bringing to the deal, how much equity they brought on. So this is not it shouldn't cause any issues with the returns to the investors just because there's multiple GPs on. The GPs just share within the profits.
Yep, absolutely, makes sense.
I just seen somebody say, thank you both, very helpful, go Canucks, go. Even though we're not big hockey fans, but yeah, definitely. And if anybody ever comes to Vancouver, Canada, make sure you give us a call because we would love to meet you. The
only thing you have to be accredited. That's we love to wine and dine you, but you have to.
Kidding.
I'm just joking around.
Right. So you guys, you mentioned that. So what's the best way for people to reach to you?
Okay. Yeah, absolutely. We love LinkedIn. We're super active on LinkedIn. So Ava Benesaki, reach out to me, send me a message. I'll get back to you right away. And then August loves LinkedIn.
Yes, and you can search our company CPI Capital on LinkedIn. We'll pop up there. Get in touch with us. We have a YouTube show. We have an investor community. We have our website, cpicapital.ca. And we really enjoy connecting with others, adding value in any way we can. So get in touch with us. Don't be shy.
Yeah, sign up to our newsletter. We give great content once a week. We send out a weekly newsletter on Sundays. So please sign up. You can book a call with one of our team members, and we would love for you to learn more.
Perfect. Thank you so much for being here today. It was a pleasure.
Yeah, thank you so much for having us, and nice to meet you all. Thank you so much for coming.
All right.
Bye-bye.
Bye-bye.
See you guys. Thank you.